Wall Street has been selling you a dream. Low fees, instant diversification, and a hands-off path to retirement bliss. They call it the ETF revolution. But behind closed doors, some ex-insiders are warning that this so-called revolution is quietly turning into a retirement trap. And the most dangerous part? It's not the obvious stuff. It's the funds that look perfectly safe. The ones buried inside 401(k)s and IRAs across the country. The ones you probably already own. According to a former Wall Street analyst who spent over a decade dissecting financial product from the inside, certain ETFs are quietly eroding wealth, siphoning growth, adding hidden risk, and making retirement portfolios far more fragile than most investors realize. And the worst part? These dangers rarely show up on your brokerage statement until it's too late. In this video, we're going to unpack exactly which ETFs raise red flags, why they're so popular despite the risks, and how smart retirees are protecting their nest eggs before the cracks show. If you're depending on ETFs to carry you through the next decade, this might be the most important wake-up call you hear all year. One of the biggest red flags? High-yield bond ETFs masquerading as safe income. They promise stability and attractive yields, which sounds perfect for retirees looking for predictable cash flow. But under the surface, many of these funds are loaded with junk-rated corporate debt, the kind that can crumble in a market downturn. Wall Street packages it up, slaps a nice name on it, and sells it as a low-risk income solution. But in reality, these ETFs often behave more like ticking time bombs during a recession. When credit markets tighten and defaults rise, the value of these funds can drop like a rock, right when you need the income most. Worse, many investors don't realize that the liquidity in these ETFs can dry up fast. Unlike individual bonds that pay fixed interest until maturity, these funds trade like stocks. And in moments of panic, the gap between what they're worth and what someone's willing to pay can widen fast. That means if you try to sell during a downturn, you might walk away with far less than you expected. And when you're living off your investments, that kind of surprise can derail an entire retirement plan. But these aren't the only ETFs giving off silent warning signs. Another hidden danger lurks in ETFs that track popular market indexes, especially the ones heavily weighted toward tech giants. On the surface, these funds seem like a no-brainer: broad exposure, low fees, and consistent growth over the past decade. But what many investors don't realize is that some of these ETFs are far more concentrated than they appear. For example, what's advertised as a diversified index fund may have 30 to 40% of its weight tied up in just 5 or 6 companies. That means your entire retirement future is riding on the fate of a handful of overvalued megacaps. This kind of hidden concentration risk is especially dangerous for retirees. In your working years, you had time to recover from market corrections. But in retirement, one bad year, triggered by a tech correction or regulatory shock, can permanently shrink your portfolio. And with the growing influence of AI hype and tech speculation, some ETFs are becoming more volatile by the day without any warning label. Even worse, most investors don't rebalance or check what's under the hood. They assume the word index equals safety, not realizing they're holding a fund that's more speculative and secure. And if a downturn hits when you're drawing income, you may be forced to sell at the worst possible time. But that's not the only illusion ETFs are quietly selling. Then there's the myth of low fees, Wall Street's favorite bait. ETF providers love to flaunt expense ratios like trophies, boasting fees as low as 0.03%. And sure, those numbers look amazing on paper. But what they don't tell you is how some ETFs quietly bleed your returns through something far sneakier: poor tax efficiency and internal trading costs. Especially in actively managed or niche sector ETFs, hidden churn inside the fund can trigger frequent taxable events, silently chipping away at your after-tax gains. For retirees and taxable accounts, this can be a slow, relentless drain on wealth. You think you're saving money with that rock-bottom fee, but year after year, you're giving a slice of your returns right back to the IRS. And it's not just taxes. Bid-ask spreads, slippage during volatile markets, and poor tracking performance can all eat away at the very edge ETFs are supposed to give you. It's like having a leaky bucket your retirement dollars keep pouring in, but more than you realize is leaking out. And here's the kicker. Most retirement investors never notice. The statements look fine. The branding is sleek. But when it comes time to use that money, the balance just isn't where you expected. And for some, that realization comes too late. But these hidden costs are just one layer of the trap. Another major blind spot? Target date ETFs. These funds are marketed as set-it-and-forget-it solutions, promising to automatically shift your portfolio into safer assets as you approach retirement. But here's the catch. Not all target date ETFs are built the same, and some are dangerously out of sync with what retirees actually need. While they may reduce stock exposure over time, many still leave you overly exposed to interest rate risks, inflation, or market shocks that don't align with your personal situation. Worse, they assume that everyone retires on the same timeline with the same income needs and the same risk tolerance. That's never been true. But Wall Street treats your retirement date like a formula, not a life event. Some target date ETFs keep large portions of your savings locked in long-dated bonds, even when interest rates are spiking. Others underweight inflation hedges like commodities or dividend-paying stocks, leaving you vulnerable when your purchasing power starts to shrink. And if you think they're adjusting your risk in real time, think again. These portfolios follow rigid glide paths set years in advance, not based on current market conditions or your specific financial goals. So, when markets change quickly, your safe retirement fund may be completely out of step. But that's not the only way ETFs can quietly mislead even the most careful investors. One of the most misunderstood traps? Dividend-focused ETFs that promise steady income. At first glance, they sound like a retiree's dream: regular payouts, solid companies, and a strategy built for cash flow. But under the surface, many of these funds are dangerously concentrated in a few high-yield sectors like utilities, real estate, and financials. That kind of narrow exposure makes them highly vulnerable to economic shifts, rising interest rates, and sector-specific downturns. Here's what most investors don't realize. Those juicy dividend yields often come at the cost of price stability. When interest rates rise, bond yields become more attractive, and dividend ETFs suddenly look less appealing. That can trigger a wave of selling, crushing your share price even if the dividends keep coming. Meanwhile, companies under pressure might cut payouts altogether, wiping out your expected income just when you need it most. Even worse, some dividend ETFs chase yield. So, aggressively, they end up holding shaky companies with unsustainable payout ratios. These are firms teetering on the edge, borrowing just to keep dividends flowing, creating the illusion of stability while piling on risk. If one or two of these companies falter, your entire ETF can take a hit. And when your retirement depends on that income, the fallout can be devastating. But we're not done yet, because there's still one more trap that even savvy investors overlook. And then there's the illusion of safety in bond ETFs, perhaps the most deceptive trap of all. For years, retirees were told that bonds were the bedrock of a stable portfolio. But in today's environment, many bond ETFs are quietly packing far more risk than people realize. That's because they often hold long-duration bonds, which are incredibly sensitive to interest rate changes. When rates rise, these bonds drop in value fast. And if you're holding a bond ETF during that shift, you're watching your so-called safe money bleed. Unlike individual bonds, which return your principal at maturity, bond ETFs never mature. They constantly roll over into new bonds, which means you never get that full recovery unless the market turns your way. And while the yield might look decent on paper, inflation can quietly erode your real returns year after year. Retirees who thought they were playing it safe have found themselves stuck in funds that deliver neither protection nor predictable income. Even worse, some ETFs take on hidden credit risks, loading up on lower-rated bonds for a bit more yield, without making that risk obvious to investors. It's a silent gamble most don't see until it's too late. You think you're holding a conservative asset, but behind the curtain, it's a ticking time bomb. And now, with economic uncertainty rising, the real question becomes, what happens when all these traps start triggering at once? Finally, there's the false sense of control that ETFs give retirees, especially those managing their own portfolios without realizing the full consequences of their decisions. It's easy to feel confident when you're clicking through a brokerage account, moving funds between ETFs with just a few taps. Everything looks modern, efficient, and low cost. But what's missing is strategy. And that's where the real danger begins. Too many retirees fall into a pattern of reactive investing, chasing returns, following trends, or bailing on positions when markets get rough. And because ETFs are so easy to trade, the temptation to tinker never goes away. One bad decision during a downturn, one emotionally driven move based on headlines, and years of savings can take a hit that's impossible to recover from. This isn't about intelligence, it's about structure. Without a disciplined withdrawal strategy, tax planning, and long-term income mapping, even the best ETF portfolio can unravel. And then there's the tax side. Selling the wrong ETF at the wrong time can trigger capital gains you didn't expect. Taking distributions without coordinating with your RMDs or other income sources can push you into a higher tax bracket. Suddenly, your simple ETF plan becomes a tax headache that quietly drains thousands of dollars a year. It's not just about which funds you buy, it's about how and when you use them. And for retirees, getting that wrong is a trap they often don't see until the damage is already done. So here's the quiet truth most retirees never hear. The ETF you trusted for simplicity could be silently working against you. Not because ETFs are bad, far from it. They've revolutionized investing with transparency, liquidity, and low fees. But when you step into retirement, the rules change. What used to be a great strategy during your accumulation years can turn into a series of costly missteps if you're not adapting fast enough. Target date funds that don't match your real retirement path. Dividend ETFs chasing high yields without stability. Bond ETFs pretending to be safe while bleeding value. And worst of all, a DIY approach that feels empowering until the tax hits, market swings, and timing mistakes start stacking up. Retirement isn't the time to wing it. It's the time to reevaluate, re-strategize, and recognize that passive investing still requires active awareness. Because every percentage lost now isn't just a number, it's time, freedom, and security you can't get back. The solution isn't to avoid ETFs altogether. It's to ask harder questions about what's underneath the label, how each fund fits into your overall plan, and whether you're truly prepared for what lies ahead. So, before you assume your ETF portfolio has you covered, take a closer look. The trap isn't in the tool, it's in how it's used. And the smartest retirees are the ones stepping back, rethinking everything, and refusing to get caught off guard.